time since December of 2024. The rate is now down by 0.25%. We're going to learn more about why they decided to cut.
This was largely expected, Katie, going into this meeting. It's what Wall Street thought would happen here. And the reason for it is there is a sense on many members of this committee that the Fed is a bit behind the curve here when they look at the labor side of the Fed's dual mandate. So for so long, really since COVID, a huge focus has been on the inflation picture, and inflation remains higher than the Fed would like it to be. The target is around 2%. We're still removed from that. But in recent weeks, we've seen deteriorating data when it comes to the jobs market, when it comes to the labor market. And I think back on the monthly jobs data for August, the revisions that we saw to payrolls on the heels of that, weekly jobless claims. So that's made the Fed have to shift its focus a bit. Again, I mentioned that dual mandate, which is a wonky term, but the Fed has these two goals. One is to focus on price stability or getting inflation under control and keeping it under control. The other is trying to achieve maximum employment. And I think what you see here today is the Fed acknowledging that.
Welcome back to the channel. Every time the Fed Chair, President Jerome Powell, speaks regarding interest rates, paying attention, especially if you are looking to buy a home, looking to restructure, getting a better position, so on and so forth. So I wanted to give you 3 things that you should know, and maybe a bonus so that you're not taken advantage of. I'll say that. For those of you that don't know me, my name is Robert, and on this channel, the goal is to simplify the home loan process. So we want to hear a summary of what the Fed chair said, and then I'll add the 3 things that you should know so that you'll be prepared and can move forward with confidence. Let's get into it.
Well, what we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, you can I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that. But we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
So let's dive into these 3 things. Before you can really get a grasp on what just happened on yesterday with the 0.25% rate cut, you have to understand that whenever a big machine, a big ship turns, it turns very slowly. What I mean by that is this. In my opinion, the Fed as it sits now is been reactive. And whenever they do something, it takes a long time to really show up in your and my everyday lives. Keep that in the forefront of your mind as we move forward. Now, the Fed's job, the goal, the mandate is to keep prices in a range where everybody's happy, which is impossible, as well as keep employment at a very good percentage. Everybody's fully employed, prices in a good position. And so inherently, if you really sit down and think about that, this is why everybody can't have a job, because if everybody, let's say this is money, if everybody has these, say for sake of example, this is worth $1 million. Everybody has $1 million, but everybody wants one of these, and there's only one of these. Well, the cost of this, the price of this is going to be very high, okay? Because you have too many goods, or too many dollars, pardon me, people with money or whatever the currency is chasing little goods, inflation, supply and demand. And so, as he stated, they were very slow in moving. Really, if you really think about it, in my mind, is because of this. We have to control the amount of money in the system. And the last little cycle that we had, due to the lockdown and things of that nature, there was a lot of money printed. So there's a lot of people with a lot of money. So that's how they were attacking inflation. He said it himself. And if you follow these things, and if you don't, there's been a crazy revision policy going on over this past year. I really don't believe the job numbers. I take my own survey just where I am. Okay. And I advise you guys to do that. We got to start going back to Stop listening to what everything these professionals or experts are saying, and pay attention to what's going around you, in your house, at your schools, in your community, the employment, the jobs, and you can see what's really going on. So all that being said, the 1/4 point rate cut is reactive, and the stock market really didn't respond to it positively because they were looking for a 50% cut, because that would be more in line with moving the economy. At the end of the day, it's like this: no jobs, no money, stuff doesn't move. On top of all of the taxes, the tariffs and things of that nature that are making prices more expensive. Okay. So what you should know, if you are, say, looking to get into a home, purchase a home, the Fed funds rate does not have a direct correlation with mortgage interest rates. Rather, the economy really does. The jobs and inflation, things that we just spoke about. Because if you're unsure about your livelihood, what's the likelihood of you wanting to go purchase a home? This has manifested itself in my industry over the last couple of years, not in the bottoming of the value of the underlying asset, the home, but in the number of transactions. At the height a couple of years ago, there was over 6 million homes sold. We're going to be in the 3.5 to maybe 4.5 at best million transactions going for the foreseeable future. That's where you really have seen the bust, in my professional opinion. It's in the number of people transacting, because you have a lot of folks that have lower interest rates that aren't moving. So they're not playing and putting that inventory back in the system like it normally should be. And then builders have been building less since 2011. Don't let anybody fool you. So there's a ton of people that want the good, but either they're afraid or they're not making enough money to get it because of the inflation. But the 1/4 percent point will directly affect car loans. There's a lot of you guys that are lamenting online about car payments. This is a good time to potentially reposition that loan and get a lower interest rate if you've taken care of your credit. Student loans. If you've done your due diligence and you decided, hey, I am going to go to school, not the loans that are already in place, but ones that you're going to be taking in the future, these things are directly affected by the Fed funds rate. Credit cards, obviously, can have a direct effect. The Fed fund rate can have a direct effect. And then HELOCs and or HELoans. If you're blessed to have a property and you bought it prior to 2020, most likely you have a great interest rate, hopefully, and you're sitting on a lot of equity. Well, with a HELOC and or HELoan, you can now come in, tap into some of that equity to reposition, start business, whatever it is that you guys do. But you can do so without touching that lower first interest position. So these are things that the Fed fund rate affects. Now, the second thing is this: if you are in a position where you have higher interest rates on certain debt, do not sleep on these opportunities. I'm seeing in my practice, there's more month in there's more living in the month than money. The money's not stretching as far because of inflation, the things that I just aforementioned, tariffs, and not only job losses, but the whole kit and caboodle. Okay. And so that's the second thing that you need to know. You need to move, not like the Fed. Stop being reactive. You have to be proactive and look into your situation, or don't expect it to get better if you're not going to address it respectfully. The last thing that I would say that you should do is consider the source. You're going to start seeing a lot of people pop up that's in my industry, real estate agents, folks that have been on YouTube that hadn't said nothing about a home loan or mortgage or anything of that nature. Now, all of a sudden, they smell, it's money around again. And so understand these things, guys, when you're moving forward. So just to recap, Fed funds rate does not directly affect mortgage rates. If you want to follow and get a better feel on mortgage rates, it's good to follow the 10-year Treasury note. Okay. Anytime that note is trading under 4%, bodes well for interest rates. Anytime the economy is looking shaky, bodes well for mortgage rates because people go from the stock market to more bonds. Historically, that's been the case. Here over the last couple of years, everything's been messed up, not so much. But when you look across this planet, until the big man changes things, this is the best game in town, meaning America, and this debt. And mortgage-backed securities, those bond auctions are still attracting buyers. So this is how you track the mortgage rates more. And then make sure you have a good communication with a professional that you can lean on in times like these. And then, like I said, the last thing is do your due diligence. You will know them by their fruits. Don't let these folks pop up and watch your timelines and stuff. Everybody's going to be talking about interest rates and mortgages because they're trying to get in your pocket. My time is up. I thank you for yours. As I always say, guys, let's be good to one another. Let grace abound. And watch this video right here if you want to learn more about HELOCs and HELoans. Until the next time, indeed, y'all stay blessed.